Thank you, Jez. Morning, Stephen.
Should we do this?
Appropriate that we start by looking at the housing and mortgage markets from a consumer's point of view. So, Stephen, what are they facing into these days?
Can I have the first, or my first and only slide, actually, please? And I promise you, charts are not going to feature a tremendous amount on this, but if there is one chart that shows the past, the present, and the future of our industry, it's this one. And the first thing I'd like to point out is the tremendous job that we've all done getting people into their homes. That blue line going onwards and upwards to the right is people who now own their properties outright in the UK. But the orange line is people buying a home with a mortgage. That's what we all do on a day-to-day basis, both lenders and brokers. And that's actually it is starting to decline as more and more people own their own home outright. And you'll also see there the red line, the increase in private renting. And in fact, by about 2025, there'll be a handover, there'll be more people in the private rented sector than will actually actively be buying a new home with a mortgage. And these figures, these lines, have a lot of implications for us, as we'll see as we move forward.
And my first slide now, please, as well, which is talking about some of the misnomers in the market. If you ever want to find an economist to discredit, you'll find them talking about the top left-hand chart. That's a measure that looks at house prices in relation to income. The fundamental flaw is it completely ignores the interest rates and therefore the repayments at the time. And on the face of it, people look at that chart. I've seen economists recently doing it, saying we're heading for a crisis because house prices are far too high in relation to income. And by the way, we're back where we were in 2007. Ignore them if they ever say, ignore anything they say if you ever see that. On the top right-hand side is a much better view because it looks at the cost of those mortgages in relation to income. So yeah, higher prices, houses, higher mortgages, but lower interest rates. And the way to look at this is the grey banding, which is every region of the UK outside of London and South East. It represents the two extremes, highest and lowest. And you can see on that basis, affordability is actually very good when you're in a property. Interest rates are low. Of course, it makes sense. The red and the green lines tell a slightly different story. The green line is South East, the red line is Central London. What you get in Central London, no surprises to anybody, is more of a pressurised story than the rest of the UK, but that's the only part of the story that actually applies. There's a little wrinkle here to be aware of, though, and it's that the stress rates that we're required by the FCA to use in allowing people to have a mortgage actually set the bar a lot higher than the grey. You'll appreciate that because that's your job. So unfortunately, getting in is a bit tougher, but once you're in is actually really quite straightforward. The real other problem today for first-time buyers is the size of deposit needed to get into your property. You can go back to the 80s and it was almost nil in relation to your salary. It's now a very, very big chunk, and you'll recognise that. Lower than it would have been 5-6 years ago, but that is probably the main barrier to entry we're talking about here. And the bottom left-hand chart I'll come back to a bit later on.
So don't get me wrong, buying a home with a mortgage, what most of us are doing in this room, so to speak, is still a huge market, and it's going to be immensely important going forward. But the one for the future has really got to be that growing number of people who own their own property. They're the people who own their property outright, and they'll be thinking now as to how to use that, how to unlock the equity that they've built up, that wealth that they've built up. Because they're the same generation that face severe demands on the bank of mum and dad. The same generation who are less and less likely to have an occupational pension scheme that pays them out in terms of final salary. So using housing equity alongside the wealth in their property and their other assets is going to be how they maintain their lifestyle in retirement. So it's a key market. The CML in its report last year said it was going to be growing to around 140 billion over the next decade.
And the key point here is to access this pot of money, you have to own your house by the time you retire, or at least own the vast, vast majority of it. A recent study, which I've seen some work on within Lloyd's just very recently, suggests that people should now be saving 15% of their salary from the first salary check they ever get to live in a modest retirement, assuming they retire at 70, people starting work today. That's a huge load. But if you're planning to have to retire with a rented property to live in, you should add half onto that again. So the extra cost of saving for your retirement to pay for your rent is far, far better invested in the property that you might own on that lifetime journey as well. I'm going to just press on a little bit more because I think, let me talk about this chart. You might have seen this from me a year ago. This is pretty much the traditional view of the UK mortgage market, gross new lending, relationship, direct business from lenders at the bottom, low and staying low in relation to the growth of intermediary. All the growth in intermediary since the recession has been the entire growth of the market. If you look at share as a first build, please. That's the 70-ish, 75% share which intermediaries would recognize as their own share of the market today, up from about 50, 6 or 7 years ago. Okay, next build. This adds in product transfers. The dark blue chunk is the direct product transfers, direct to lender. The light blue is the arrival of the intermediary from a very small place a few years ago, in fact, from a very small market overall a few years ago to a dramatically bigger market. These are new numbers. These have to be my numbers because there is no published data on this one, but I can assemble data from lots of different places. And in fact, I'll be upping my estimate of where we were last year by about 20 billion, given the latest insights you can now get. Broker is now about 35% in 2017 of the market, heading for 40%, I think, this year. But you can see the size of this market probably heading for 200 billion in 2018. It started to catch up the growth of the market we traditionally regard as the mortgage market, which is the gross new lending. And the key point here, when you look at the line, is the broker share of the entirety of the market is nearer to 60%. That's quite different from the 70 we start from, because brokers have never done as well in the PT market as they have done in new acquisition. These are your customers. These should be your retention opportunities as well. Getting much better, but some way to go.
So that 60% there is a fantastic starting point, but it's there for brokers to lose. Customer expectations are rising, and their expectations are set by the service of the product that they received most recently in other parts of life. So if Amazon Prime can deliver the same day, why can't everybody? If I can get a credit card decision in minutes online, why can't I get a mortgage like that? And if I feel confident about what I'm doing, why do I have to sit through a 2-hour interview either with a bank advisor or with a mortgage broker in their offices? So some significant challenges for the distribution in our industry moving forward.
And in thinking about the future, we have to start with the customer. Technology and possibly even the regulator will create opportunities as we look forward. The traditional competition with the face-to-face direct business, I think, has been long won by brokers compared to the branches of the lenders, and I don't see that being very different at all in the future. But the really interesting question is those simpler needs that customers have that have been satisfied more recently, for example, the execution-only product transfer market. If it's easy and it's quick and you've got a confident customer who knows what they're talking about, decent level of knowledge, it's not surprising they're transacting in the easiest possible route.
But those words you use, confident customer and a decent level of knowledge, don't necessarily reflect the knowledge base of the customers we come across on a day-to-day basis, particularly first-time buyers entering the market for the first time. But it does pose the challenge that brokers are going to have to need to change and adapt and adopt new ways of doing business, applying new technology that deliver those service expectations which consumers now expect. And a significant proportion of that will be in the mainstream market, no matter what happens on robo-advice, etc., where slick, low-cost processors can get the customer to the point of knowing they're going to get that mortgage at a much earlier stage in the process. So I would say challenging times ahead for the broker market.
Yeah, and let's keep going, because it's wrong to think of mortgage distribution in the future just in terms of brokers and direct lenders. The Support Act of credit reference agencies, sourcing systems, social media, even certainly aggregators, all have radical options to move up and down the value chain that we regard as our own today. The most obvious of all are the aggregators. Today, they provide paid leads. It's not hard to see the power of the aggregator harness to some form of robo-advice. That doesn't exist today in the market, but one could imagine it in the future across the UK. Let me paint a scenario. If Money Supermarket, or similar, others collecting customer data, were allied to sourcing systems with good access to product information, credit reference agencies to validate the identity of customers and to prove their credit worthiness, and critically confirm affordability, because that's the next race, isn't it? And then a robo-advice system at the end to then work the algorithms on those customers to produce the answer. It's hard to see that not being a solution for some. And if that is the solution for some, is it scraps that are left over for brokers falling off the table, or is it actually the lion's share of the market?
Well, I think it's got to be the lion's share of the market. In the majority of cases where consumer needs and circumstances are often more complicated than they will appear on a screen, the broker will work with the customer to understand and establish those needs and find the best borrowing solution. So as I said on this stage a couple of years ago, don't be afraid. Robots don't empathize. Algorithms don't engage with a customer. And it takes that human touch to say the difference between what people say and what they actually mean or put on a form. So I think there's a great opportunity for advisors to provide that advice and earn a good living and provide better consumer outcomes. So brokers are essential both in these new growth markets and in the markets such as later life lending and buy-to-let through excellent technology, delivered service. And MAB is going to be at the cutting edge of these plans, delivering flexible, relevant customer propositions.
And I couldn't agree more, because human beings supported by excellent technology feel like the answer to me too. And to be very clear, brokers are essential to the future of Lloyds Banking Group. You deliver me a packaged, error-free solution that I pay for on completion. That's valuable too. You value the service and proposition I provide, and don't recommend simply on price. That's important to me too. I don't see aggregators doing any of this, and I see how they've changed other markets, and you can look at motor and you look at GI and recognise the impact they've had on that. It's not all good. I vote for human brokers every time.
Well, it's good to hear that continued commitment from such a big and important lender as Lloyds Banking Group. But moving on to another matter, in specialist markets as these evolve, these developing markets, are they going to be catered for, do you think, by the challenger banks, the new lenders, or do you think the big lenders will choose sectors to get involved with as well?
Well, this is where we talk about the word niche so often, isn't it? And what do we mean by niche? Because for a niche segment of the market to be of interest to the mainstream lenders, there's got to be factors involved. You're not looking about small particularly. You're not looking at things that are hard to scale, that are hard to industrialize. You're looking at markets where there is real customer need, where we can see a trading opportunity that makes sense in a scale which either exists or will exist. You're definitely looking for a good growth opportunity. And in a situation like that, there is real interest from the mainstream lenders. If it's not that, or if it's particularly marginal credit, then I think that remains natural territory for the challenger banks. And an example for me in the Lloyds stable, I believe passionately in brands, and we operate Halifax, Birmingham Midshires and Scottish Widows Bank. SWB is a good example of what many would regard as a niche market, the offset market in the UK, but also one of tremendous growth for us, and it's neat to associate a brand like ours with a market like that. It's been very successful for us.
And another thing that's been taking up all our time over recent years, and I'm sure I've stood here before and talked about it, has been the massive amount of changes in regulation that we've had to adapt to. So new systems for lenders, new ways of working for the brokers. It'd be lovely to think we could just have a few years of just getting on with mortgage business. The market report from the FCA said that the market is operating well. Do you think they'll give us that luxury?
Well, it's the interim report, but it has given us a pretty good bill of health. I think there's an interesting nuance in what they've said about one thing, which is advice. They're definitely looking at the difference between execution only at one end and full advice as we regard it at the other. And I'm not clear where they're going on that, but there's some thought about, is there something else they need to consider? That might involve system changes, regulation changes, but the other thing seems much more straightforward, and it's about providing clearer, transparent information to the consumer up front, with an ambition that the customer at the outset of a process can get a clearer view, not just on the products in the market, but the products available to them for the proposition that they have. I think we'd all applaud that. The trick is to make sure that that's information delivered to brokers in the way that works for the future, as opposed to, and my fear, as you heard it earlier on, is it's technology that delivers that direct to the consumer with all the ramifications I think that might follow from that.
So if you want to be geeky about it, it's section 9 in the interim report. I found that really interesting, talking about the tools that are available to consumers and to brokers. And I think the FCA has hit the nail on the head. There's this point that it's all very well to have a sourcing system that will give you a list of lenders that may lend to your customer, but wouldn't it be great in this day and age if you knew upfront with certainty that that customer was eligible for the mortgage should you put through the application to that lender? And that's where, when we hear more later on from 27 Tech, their new mortgage apply system comes to the fore, because that really changes everything. One other thing though, Mike, on the housing market, a lot of people are here involved in the new build side. Continued challenges. Another report out last week saying that there's now a 4 million homes shortfall in England alone, and that we need to be building 340,000 new properties per year, not the 300,000 the government said. What role are big lenders playing in that to get this broken housing market moving again?
There's any number of numbers quoted by politicians and industry bodies on this one, but clearly there's a problem. I've got a chart I'm going to show here, please. So this is the bottom left-hand chart you saw earlier on. So first of all, set a bit of context. Green bars are simply how many houses, properties get built per quarter across the UK, and you can see a picture of 40, 50,000 per quarter. That's 160 to 200,000 per year pre-recession, halving in the recession, and then rising since. That's half the story, because that's about supply of property. The other half of the story is about demand for property, and that's about the number of people, households, who are trying to buy houses. The red line tells the really interesting story, because up until 2008, you can see the red line matched up to the 0 on the right-hand side. In other words, there were no more households being created than properties being created. That's how it should be. What's happened since then is we're not just not building as many houses even though we're growing, but actually the number of households has grown enormously. Now actually, you can see it's changing, and peculiarly, or maybe not, it's the Brexit vote, and it's the arrival up to that point and the departure since that point of a relative balance of people from Europe. That's a significant change. So there's a social change going on here. But where you get to is we're now running 15 to 20,000 per quarter, less properties being built than are needed, which is where kind of a few months ago, back in 2016-17, people talked about there's 100,000 a year shortfall, the 25,000 number. It's probably heading towards half that, but it's still a real problem for us. And if that's the nature of the problem, then things like Help to Buy, enormously important, and where we go post-2021 is enormously important for the UK. But on probably the most important thing is how do we build more houses? And certainly, pre-recession, it's the demise of the smaller builder that led to the collapse in house price production. We, Lloyds, and the government have a joint venture. We're working together there trying to invest equity in builders, in more than 100 builders now, with the 14th biggest house builder in the UK as a consequence, which is somewhat surprising. But it's about helping builders to get off their feet and start to expand. It's a good example. You look more broadly at L&G, a great example, your old shop, around investment in housing associations, social housing, innovation in the way that we build properties. There's actually quite a lot going on, and I think it's incumbent on us all, and particularly in my world, to make sure that we're part of building the future here to help these houses get built for the people who undoubtedly need them.
It's amazing who's getting into the building game these days, I think. So we'll all end up house building. Self-build, custom build. Must be a lot of you in that market here as well. I think we probably could go on talking like this all day long, but we need to let these good people get on with the rest of their packed agenda. So, ladies and gentlemen, thank you very much indeed for listening.